What's up, everyone? Welcome to another episode of Finance Simplified, the official podcast for Street Fins. We're here to break down the world of finance for you to understand from a relatable perspective with discussions with experts. My name is Rohan, and this is episode 33. I'm back after quite a while, and I'm joined by my co-host, Alex. Now, I obviously know what's been going on with you, but could you give an update to our listeners?
Hey Rohan, glad we're back. Just wrapped up school a few weeks ago, and have started my internship for the summer.
How's New York so far?
Fantastic. Fast-paced and the food is great. What are you up to this summer?
That's awesome. New York City is absolutely incredible. I'm actually interning with my university's endowment, which is kind of perfect because the topic of this episode is simplifying university endowments. So Alex, what are university endowments and why are they so important?
Well, university endowments are investments the university makes with donor money. The returns on these investments are critical for keeping a school running and allowing it to fund its various operations.
Yep. And collectively, university endowments manage more than $800 billion in assets as of the end of 2021. We're actually going to be talking to the Chief Investment Officer of Princeton University's endowment today, which is among the top 5 largest endowments in the United States. We'll be making this topic a 2-part conversation. So this episode is part 1, and we'll be releasing part 2 in about 2 weeks from when this drops. Additionally, we just want to remind you that if you're learning from our episodes and want to keep supporting what we're doing, we'd be eternally grateful if you gave us a 5-star rating and review on Apple Podcasts. Even if you're listening to this on another platform, as long as you have an Apple account or device, you can support us with the rating. We'd also love to know what feedback you have for us, so get in touch with us to let us know how we're doing and what you would like to see from us going forward. We'll be teasing the next guest at the end of part 2. So, let's just get to simplifying. Welcome to Finance Simplified, the official podcast for Street Fins created by students that simplifies the seemingly complex
and confusing
world of money. We're your hosts, Rohan
and Alex.
A university endowment is the money received from donors that is invested by a university in a variety of assets. As you can imagine, the returns of the endowment impact the university immensely.
University endowments.
University endowments.
Ivy League endowments.
Our guest today is Andrew Golden. He's a leader in the university endowment space as he is the Chief Investment Officer at Princeton University's endowment, which was $37.7 billion at the end of 2021, ranking it the 4th largest behind Harvard, Yale, and Stanford. His background and career are both so impressive that I think I'll just let him introduce himself. Hey everyone, welcome to another episode of Finance Simplified, the official podcast for Street Fins. We're here to break down the world of finance for you to understand from a relatable perspective with discussions with experts. Today we have an incredible guest, the man who leads the Princeton University Endowment. Could you start by briefly introducing yourself by giving us your name, your current role, and a quick background?
Quick background. Okay, I'm Andy Golden. I am Princeton University's Chief Investment Officer. The title that Princeton uses is President of the Princeton University Investment Company. We're not a separate entity. We are a university office. And my background is a little bit circuitous. So can I use a little bit more than a quick intro to that?
Yeah, I mean, our next question is, how did you actually get interested and pursue this career in finance? How did you come to join a university endowment rather than maybe a traditional, hedge fund or another asset management? What specifically drew you to endowments and what about your background kind of pushed you towards it?
Well, I had a previous career as a starving artist. So when I say circuitous, I mean circuitous. As a kid growing up, I was always interested in photography. In my senior year at college at Duke University, I had an opportunity, even though I'd never worked on the yearbook before, to actually become editor-in-chief of the yearbook. And at Duke, the yearbook is traditionally almost entirely photographs without a lot of words. So that threw me into an all-consuming photographic project that got me interested in seeing if I could actually pursue a photographic career. I aspired to be an artist. I should say I majored in philosophy. So, I became a philosophy major in part because someone had given me very good advice, which is choose your college courses based upon who the teachers are. Don't worry about the content. And it really was true. And in my very first college course, it was a logic class taught in the philosophy department. And the teacher was so amazing that I thought, I'll take any course he teaches. And then that, when I added up, I was going to be pretty far along the way to philosophy. And here's how he captured my attention on the first class. His name was David Ross. And he told the story about that there was a system that actually could be used to win at the racetrack. And basically, it was in the last race of each day, you should bet on the favorite. And here's why. A lot of people, most people have been losing at the track all day long. They figure that this is my last chance. So I want to try and win it all back. So that means that they skew to the long shots that pay off at higher odds. And so I'm presuming you all understand the way odds get set. Is, how many people are betting on which thing. So that means that there's a tendency for the odds for the long shots to be suppressed, and the odds payment offered for what everyone knows is probably the better horse is tend to be higher. In other words, the price of the quality is lower than the price of the low quality. And that to me just sounds so cool. And I'm a freshman, and I didn't think I was going to be an investor by any means. I wasn't even sure if society should allow the morality of people making money simply because they already have money. But that was a really cool idea. And it wasn't until years later I said, that's kind of behavioral finance. And in fact, I got a chance to describe this story to Danny Kahneman. And he said, "Oh yeah, I know about that. Those studies. You don't have it exactly right. It's not that the odds are good for you; it's that they're less bad than they are for everyone else." So, I realize that's also part of the reason why I shy away from telling people to take this course or that course, whatever. It's because where people tend to go are in these like econ and finance classes where they're giving you formulas and they're assuming away all the complexity of the world. And only in the behavioral sphere do people allow any of that to enter. I'll tell you that to support myself in my artistic aspirations, I took a number of different jobs. I bartended, I carried heavy things and drove a truck. I mentioned was involved in some sound engineering type things. And I was really excited when I got my first job, actually day job, doing photography. And I was basically at that time involved in graphic arts. I was kind of a human PowerPoint machine, even though because PowerPoint didn't exist in those days. I followed the woman who I was engaged to, is now my wife. She started law school in Philadelphia. I followed her and just took the first photography job I could get. And that involved working in the in-house advertising studio for a department store chain. I rose up there and became the de facto, the unofficial leader of that group. My official title, you're not going to believe this, was assistant to the manager. I mean, I was not the assistant manager, I was assistant to the manager of that group. That got me really interested in organizational things. And because of that, I applied to the Yale School of Organization and Management, as it was called, to learn more about how organizations operate. An opportunity came up for my still fiance, not yet wife, that caused me to defer my admittance for a year, and I decided to try something completely different. I answered an ad in a newspaper, took a math test, and went to work for a small money management firm. I got super excited about the energy involved in being involved in the markets during the day. I became a human Bloomberg machine, essentially, as an assistant to the investor there. So there's a theme there. Put out of work by technological improvements. But that got me interested in investing and not so interested in that particular job that I decided, that I didn't follow through on my deferred admittance. I went off to Yale just as the Black October, just as the crash of '87 was kind of happening. Undeterred, I still thought that investing might be a good fit, but I wanted my life to be about more than just making money. I wanted to have a social purpose, to contribute to repairing the world, as they say. And I'd heard about this thing called socially responsible investing, which was the label used at the time. These kind of labels come and go. Think of it as ESG now. And I had heard about a fairly recent alum of the Yale School of Organization and Management who had just started working in the Yale Investments office. And he had before, in between school and there, his name's Dean Takahashi. And between school and the Yale Investments Office, he had done community economic development. And I was so new to the world of finance and investing that to me that sounded like the same kind of thing as socially responsible investing. So I went off for a informational interview. And he pretty quickly convinced me that the concept of socially responsible investing, it wasn't clear that that was a good thing. Well, and it was certainly not clear that it would be a rewarding career. His argument, he didn't use this example, but I condense it down into what I call the toaster oven school of thought. The thing about toaster ovens, they don't toast as well as toasters, and they don't bake as well as ovens. And so that was the issue with trying to combine these things. But if I want to do good while investing, then they were looking for an intern in that office. And I started there and kind of never looked back. I ended up interning during the term, interning during the summer, and then continuing on post-graduating from Yale SOM. And frankly, I would have stayed there. It was a very exciting time. Dean had started at the beginning of the story. He'd been there about a year, and he'd been there about a year because a year before that, one of his best friends in the world had just started as the new chief investment officer at Yale. And his name became fairly famous as David Swenson. So David Swenson was, different schools call him different things, but was like the residential college advisor, meaning he was, as a new grad student, he lived in the dorm that Dean lived in as a freshman, and the older guy was meant to provide some semi-adult supervision. So they've been friends since then, and they had a natural affinity because they're two of the smartest people I've ever met. So it was really exciting to be at Yale fairly early on in the development of the Endowment Model, and maybe have played a little bit of a small role in helping that happen. Frankly, I would have stayed there forever, except for the pay was horrible. We couldn't afford it. My wife and I had accumulated a lot of student loans. We both had professional degrees. She was a lawyer, but after practicing law for a little bit, she had an opportunity to become an adjunct professor. Adjunct means very low-paid professor at a series of law schools. So neither one of us was making enough to really afford our loans. And so I went to Dave and said, "Can you help me out here? I think I know what you make. And I'm not sure that's even enough." And the endowment field didn't pay as well as it did now, but Yale in particular paid among the worst. He picked up the phone, called up his peer at Princeton, who gave me an offer at a somewhat more senior level, which would involve triple my compensation, to give you a sense of magnitude. I, meanwhile, had reached out to the Duke Management Company, the old school office, and they offered me a somewhat more senior level at double my compensation. So I took the Duke job because both of these were going to be great jobs. Duke, had other ties to, and it seemed like it was in a particularly important inflection point in the office's development. Could have some impact, and double was enough for me. So I went off to Duke, and then 18 months later, Princeton called back and said, "Actually, it's been a little change here. We'd like you to run the office. There's a lot going on in this office. There's some kind of restructuring." And that was an offer I couldn't refuse. So that's how I eventually got to lead what was then the third largest endowment management office. And it was a fairly blank slate because what happened is my predecessor had gotten approval to spin out a for-profit firm that was going to, for at least some period of time, manage all of the non-marketable investments of the endowment. So that's how I got there. He had taken the staff that had been PRINCO with him, and I got to show up in 1995 with a very blank slate with an endowment that was, at the time, about $3.5 billion. It's about $38 billion today.
I think out of the many guests we've had on the podcast, you have to have one of the most unique and unconventional stories. So, that's fantastic to hear. I kind of want to start at the basics of, endowments for our listeners, and maybe we can start by kind of just walking us through what a university endowment does. What's its main purpose? What does it traditionally invest in, and how does it raise capital?
So the endowment mission, the objective function is it's here to be spent. It's not meant for bragging rights or as any kind of signifier of prestige. The endowment is supposed to pay for the university's excellence. And we try and spend as much as possible out of that pool of funds, subject to two constraints. We want future generations to get the same benefit as current generations. There's a term that gets thrown around a lot called intergenerational equity. So that means that we've got to kind of keep reinvesting enough money to stay ahead of inflation. And, you know, an important part of the endowment mission is to fund something forever. So when you're trying to beat inflation forever, it's a really tough challenge. I'll compare it to like a retirement account, a pension. So one constraint is that the spending rate is such that we can reinvest to beat inflation. The other thing is that endowment is paying typically for something specific. And even if it's not specific, in the case of a place like Princeton, it's paying for a lot. So even if it's not restricted by a donor, say, whatever it's paying for is important. And so at Princeton, the endowment pays for about 2/3 of everything we do here. Switch back and forth between calling it the endowment, but really the endowment comprises lots of individual funds as well. So one constraint is that beating inflation. The other constraint is that the spending coming out of the endowment has got to be fairly stable, right? So think about if we're paying for 2/3 of everything, then we've got to be able to spend even in years where returns are not great. And I'm going to simplify it, speak heuristically, as we say, and say that essentially how that works is you kind of sort of don't spend as much as you could during the fat calf years, during the great return years like we just had, in order to be able to continue to spend during the lean calf years. So if you kind of iterate on this, and it's a little bit circular, you get to a point where you can think about spending something around 5% each year. Spend about 5% each year. Inflation, call that 3-4% in typical years. We went through a period, a long time, where inflation was very low. We may be entering a place where it's very high, maybe on average something like that. And then that overshooting cushion, because since you're still spending during the lean calf years, if the market's fluctuating, then it goes down, you spend, it rebounds, the market gets to where it was. Your fund has not gotten to where it was because the rebound was on a smaller base. So 5% might sound like not much to people, but if you Google how much should I save for my retirement, you'll tend to get these calculators that often use some variation of think about what your expenses are, think about what sources of income you're going to have, like Social Security, whatever your unmet need is. You should probably divide that by 4%. You should probably save 25 times that amount, because that tends to create enough money that you won't outlive it. So humans have this sad and yet sometimes helpful feature that they're mortal, right? So when you're planning for your retirement, you can be drawing down the basic principle along the way, right? Because you're not going to live forever. But the endowment is meant to pay forever. So we can't be drawing that down, right? So absent any special advantages that we might have, then maybe we should be spending less than 4%. Now, we do have advantages. We have tax-exempt status is important, but also places like Princeton and other large endowments we have access to different types of investment opportunities than individuals would have. And importantly, we can staff up to know which of those different things are attractive. So I couldn't possibly invest my money as well as I can invest the endowment because I couldn't afford to pay 22 people to focus on finding great opportunities, right? And we've got 22 investors here, and not to mention the other same-sized amount of people who are doing all the kinds of support work. So I'm hoping that's answering your question. Where did I leave out? Maybe the source was primarily donations, right? And so people create an endowment fund as opposed to other forms of donations, like some people give buildings, right? A lot of schools hit their, Princeton's really good at this, hit their alums up for the annual fund, right? That giving, the annual fund means that whatever you're giving is going to get consumed that year. It's going to help close the gap on some budget things. The endowment fund, as I said, is forever, and so it can be attractive to donors because they're buying a little bit of immortality. Their desire is going to outlast them. It can also be attractive to donors for a very important reason, which is that there are some things that you can only do in this world, in life, if there's a real commitment, a real almost guarantee that you're going to be able to do them over multiple years. Right? So the endowment fund assures, or at least puts the odds in the favor, that a particular activity is going to last. And as I said, there are some activities that if there's not that guarantee, it wouldn't happen. So think about a really wonderful professor, right? They tend to get paid through an endowed fund, through someone gave an endowment, the Golden Chair of Philosophy, right? To make sure that there's a great philosopher, on the faculty, right? So that philosopher is somewhere doing whatever she's doing, and we say, come to Princeton. And she said, well, okay, how much am I going to get paid? I said, well, this year you're going to get paid X. I don't know what next year is going to be like because we can't guarantee that. That's not going to work, right? It's particularly important for faculty because colleges and universities, they play a very important role in society of making sure that there's true inquiry and that ideas get to compete and that there's academic freedom, that people can think about controversial things, people can speak truth to power or speak their views to power without fear of if the idea is unpopular, they're going to lose their job. And so those endowed funds kind of help promote academic integrity. And it should be obvious right now that the places where real debate, real discourse in our society are fewer and farther between, and that's very important for places like Princeton, like USC, like Stanford, that you all are in your journey, where you all are taking your journey.
Yeah, that's a fantastic overview. And, there were some aspects of sort of the endowment philosophy that I think we'll unpack a little bit later. But I kind of want to talk about sort of the institutional role of endowments within broader financial markets. And, you have an endowment such as Princeton's that's managing tens of billions of dollars. What's sort of the relationship between an endowment and other institutional investors?
Pun intended, it's a collegial network with our peers. And, the history is that endowments have actually, and this surprises many, have actually been centers of innovation in a lot of ways, right? And so go back to Dave Swenson and to Dean Takahashi and how really, if they weren't the first at doing something, they did it in such a different way. It was almost the equivalent of being the first. And so you look at things like venture capital that long had university backing, and that universities were among the earliest investors in venture. Frankly, among the earliest investors investing outside of the U.S. as in terms of other institutions. The way real estate is invested now is a lot of that has to do with a model developed by endowments. And I haven't said it yet, but most of the endowments operate the way Princeton does, where we act as a manager of managers. We're not making frontline investments. We're really trying to partner with the world's best experts within particular niches, particular segments of the investment world and different geographies all over the world. And we tend to act quite collegially with peer schools because we find ourselves in similar circumstances. So if we're going to partner with a manager who wants to do the best for their clients, it's helpful if the clients have similar needs and similar approaches, so they're not getting caught. And endowments are in a great position to take a very long horizon view, and not all investors are. So it's nice to share the kind of limited partner table with other like-minded investors. Our relation with the rest of the investment world, we are fortunate to be engaged, as I said, with the world's best in various niches. In some cases, places like Princeton and our peer schools have been helpful in creating those firms, meaning we're willing to back talent before they have an established track record. We're actually pretty good at using qualitative ways of assessing managers. And so there are many firms that their business came to being because they were able to attract capital from the Princetons, the Yales, the Stanfords, the USCs of the world.
Yeah, that's a great answer. And, it's interesting that you mentioned USC. As I mentioned before we started talking, I'll be interning for the USC endowment. So again, this episode is of particular interest to me. And one of the things that they are recommending that I do to prep for that internship is read Pioneering Portfolio Management, which was written by essentially one of your colleagues back in the day, who has sadly passed away, David Swenson. Could you talk about what exactly he did and what his influence is on the endowment space?
Look, it's hard to think of someone who's had more influence on any particular industry than David. Now, earlier on, I don't know if we'll survive the editing, I mentioned Dean Takahashi, and I think Dean deserves a lot of credit as well. Dave could not have had the impact that he had without Dean. Now, Dave got his PhD at Yale and then went off to Wall Street and helped create the swap market, but he was called back to Yale by his thesis advisor, who became provost, saying, we really could use you to help manage this endowment. And I think what Dave brought was a super sharp mind and absolutely extraordinary communication abilities. And he was willing to be different, right? So, you can't talk about Dave without him quoting Keynes about how it's much better to a person's reputation to fail conventionally than to succeed unconventionally. And Dave really put his mind to succeeding in what was then unconventional and which became the approach known as the Endowment Model. And he would not describe it this way, but I think it maybe facilitates understanding to say, basically looked at what the distinctive circumstances are of endowments and thought about the basic truths of investing and thought about, well, how does one tailor a program such that it is bespoke to the endowment's mission? And one of the things he recognized was that the endowment mission, which requires a certain amount of outflow, but only a certain amount of outflow, really meant that compared to other investors, we could tolerate a lot more illiquidity. Certain aspects of the governance meant that we could take on some volatility. When I say aspects of the governance, the major endowments tend to be all blessed by the fact that the trustees, who are the last line of defense, the ultimate fiduciaries here, within that pool, whether they're trustees or other alums who get called in to advise, they tend to be very smart people who have experience in markets and therefore don't have to just simply rely on what was your last quarter's performance. We can have conversations about what is working well, what isn't working well, and what falls into each one of those buckets might actually be different from what has been performing well versus what has not been performing well. Right? So when you set up a governance system where people can truly understand what's going on, then you can have comfort in performing quite differently from the overall market. Now, everyone is fine if you perform differently and outperform, but you can't outperform if you're not willing to take on the risk of underperforming. And the way I can summarize it is saying, like, it's a really good weapon or a really good tool to have in your toolkit, which is a tolerance for looking silly, for looking like things aren't going well. And as I said, so what Dave was able to do, again, he would not describe it that way, but that's how I describe it. And what Dave and Dean were able to do were to really explore areas that prior to that were not necessarily considered the type of thing that institutional investors should get involved in. I mean, one of the things I got involved in, working for them early on was getting involved in various forms of hedge fund investing, which, today there's big databases, but back then it wasn't like that. And so, just the idea of investing in the securities, distressed securities and the securities of a company going through bankruptcy, that sounded, a little odd. Like that can't possibly be safe or safe enough. And, but if you actually get into it and say, well, actually, this is an area where you're likely to be overcompensated for the risk that you're taking. Same thing with things like short selling. So these were areas that maybe some institutional investors were dabbling in. Mostly they were being done by, within big banks and things, but, allocators were not involved. But again, this is not how Dave would describe it, but Dave was a big believer that for at least a certain period, that if the data don't support your theory, then the data are wrong, right? Like, in other words, it's so easy to get caught up in, well, everyone seems to be making money doing this, so shouldn't we do that? And it's like, well, no, because it actually looks like that thing has become tremendously overvalued. But you can't make that assessment if you don't have a good batch of theory to rely on. And likewise, conversely, if something's not doing well, but you believe that for the world to make sense, it ultimately will have to do well, well, then that gives you the courage to step up.
Hey everyone, that was the end of part 1 of our 2-part interview with Andrew Golden on simplifying university endowments. We'll be releasing part 2 of our interview in about 2 weeks from when this releases. But the first half of the conversation was absolutely incredible. What were some of the key takeaways?
I really enjoyed hearing Golden talk about his background, a totally unique path into the endowment space, which is really inspiring.
I think another key takeaway is that endowments, like sovereign wealth funds from our last episode, are meant to exist forever, which gives rise to a long-term perspective that allows them to take on some unconventional investments. David Swenson and Dean Takahashi of Yale University really spearheaded that diversification into these unconventional assets.
Moreover, the key goals of an endowment are to grow the purchasing power of the endowment and either maintain or grow the real value of its payouts. Over time, this will allow for increasingly better educational opportunities.
Agreed. Well, Alex, that wraps up our part 1 conversation and takeaways. What can we expect from part 2?
We can expect to talk about Andy's investment philosophy, careers in endowments, his advice for students, and much more.
Part 2 will be dropping in about 2 weeks from now. We'll talk to you all then. Hey guys, I want to thank you so much for listening to this episode of the podcast. It truly means the world to us. If you like this episode and others, let us know by subscribing and giving us 5 stars on Apple Podcasts and following us on Spotify. Share us with your friends and check us out on Instagram and Twitter, both at StreetFins. You can also follow me on Twitter at RohanInvest. If you'd like to get in touch with us, please email fspodcast@streetfins.com. Thanks once again to Andrew Golden for his insights today. I hope you understand the topic of university endowments in a more simplified way. This episode was produced by the incredible Jeffrey Lee. Once again, we're really happy that you're taking the initiative to learn finance and to better your future. If you haven't already, we highly encourage you to check out streetfins.com for articles, videos, and other content. Join the StreetFins community and tell your friends about us so that they can learn about finance too. We'll talk to you next time on Finance Simplified.